sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
From the 6th floor of 3 Financial Center in West Little Rock, Arkansas, this is the Get Ready for the Future show, final show of the month of February. We are glad to have you along wherever you get the show, online or on podcast or on radio. Settle in for the next half hour or so. We're going to answer your questions about your money. And stay tuned for that as I welcome in my co-host for this week, Tim Key, who I work with here as an advisor in the West Little Rock office. And off the top here, Tim, I do want to take just a minute because this is our first show that we have recorded since the recent market volatility has taken over. And it's really odd to say since the recent market volatility. It's been a minute, really, if you really think about it. We've had a couple of small pullbacks over the last year, but very seldom have we had significant dips. And I think it's a good point in time to just talk to investors out there for just a few moments, whether you're a client of GenWealth or not. If you are invested in a growth strategy, you have to remember that it is a long-term strategy. And what has happened over the last week and a half should not rattle you. And I think there's varying ways that you can approach tricking your mind into believing that, because it's really easy if you look at it daily or pretty frequently online and you see that account value reach a peak and then it goes down, or if you're that investor that just gets the monthly statement and they're not aware of what's going on, they get a shock, right? We have a few of those that are going, wait a minute, what's happening here? Your account value's peak number is not always going to be your peak number. It's not going to be a straight ride to the top.
We wish the elevator went straight up,
Absolutely.
But we do have some ups and downs, and there is a lot of noise out there in the market at this point with some different news all around tariffs, inflation, interest rates, and that continues to happen. But, I mean, it seems like it's been a little hotter right now, and there are some earnings that will be coming out here soon that might give some more direction on how is the health of the economy. And it's really about, ultimately, the stock market's going to look at earnings and future earnings of what those companies can do. And so that's one of the most important pieces. The rest of it is a lot of noise, and a lot of that noise will drive quick, irrational decisions, which can move the market, well, really both directions. But right now we are just coming off some all-time highs in the S&P 500, and we've got a little bit of a pullback. We don't know what that's going to really look like over the next month or two. But again, if we are positioned correctly as far as a long-term mindset, we should be just fine.
It is about staying invested, and it's not about timing the market, but time in the market. You've heard us say that time and time again, no pun intended. If you'd like to stay on top of what's going on with the economy and the stock market, I would offer you again the opportunity to sign up for the fastest 4 minutes in finance. It's a weekly video that comes to your email inbox every Friday morning. And that's all you're going to get. We're not going to bombard you with a bunch of emails. You don't even have to watch the video. It's just going to be there in your inbox. If you're curious about the headline and want to learn more, get that weekly delivered to your email inbox. All you have to do to sign up is text the word FAST to 501-381-5228. If you're watching online, you can see that number on the bottom of your screen. If you're listening only, again, it's 501-381-5228. Text the word FAST. You can also visit fastest4.com, and you really just have to enter your email address, and we'll be sending that to you on Friday mornings. All right, let's dive into our questions for this week as we help people discover, protect, and share true financial independence. Lee from Maumelle is first. What's the role of alternative investments, and in parentheses there, private equity, hedge funds, etc., in my portfolio at this stage of life? I'm 62. Lee likes parentheses. Are they worth exploring given the potential for higher returns? Lee, thanks for the question. And yes, they are definitely, Tim, worth exploring. But I think it's important to point out for Lee, not solely for the potential of higher returns. And I think we do need to probably walk down this path a little bit about what alternative investments are. And he's mentioning specifically private equity and hedge funds. Those are two very different ones as well. So when he says higher returns, always remember first and foremost that generally every investment you get into, the potential for higher returns is going to be directly connected to higher risk. It is a risk-reward trade-off. So your risk tolerance matters here. But when you hear people talk about a diversified portfolio, I think oftentimes all they're really talking about is a mix, an allocation between stocks and bonds. And those are the most popular asset classes out there, and they're good asset classes to be invested in. But really, it doesn't end there. And I think this is an opportunity with Lee's question to kind of talk about there are other asset classes available to investors.
Right. Usually when you're in the company's 401k and your retirement plan, you're going to have mutual funds, and those mutual funds are going to be guided either toward equities, stocks, or fixed income type bonds. Usually you don't have a lot of other alternative investments, and if you do, it's more of a publicly traded type of an investment. It could be real estate, it could be some other things like that. Maybe private equity. I haven't seen too many of those positions in retirement plans. But when you get to 62, and really it's even 59 and a half for most companies, you can actually do what's called an in-service rollover to an IRA. And when you're able to do that, that opens up the retirement universe to you. So you're not just tied to those options that are in your current retirement plan. So once you move it into an IRA, you're actually able to get some things that aren't traded on the market. So sometimes they're going to be a lot less volatile, and they're not going to move at a whim based on what interest rates are doing or what the news and things are going on out there. So it's another stable, maybe a more stable area at times to get into, whether it's private equity or private real estate. Hedge funds are a little bit more risky at times, but the good ones definitely can outperform. But what we're really trying to do is make sure that over a long term that we're keeping up with inflation. And there's really only a few asset classes that have done that over a long period of time, and that's your stocks, that's the equity, the stock market, and you've also got the real estate and the private equity that have outperformed over a long period of time. Usually on the bond side, you may be keeping up with inflation, but you're more than likely going to lag a little bit. But that's where you get maybe into the safer areas, to where when you're in that retirement red zone that we talk about, moving 5 to 10 years out from retirement, we want to reposition some of your assets to that category. But again, at 62, we hope to have a 25 or 30 year lifespan in front of us. We still need to stay aggressive in those equities, and then also the private equity and the real estate are some good options to diversify your overall portfolio.
Yeah, we should put a disclaimer out there. This is not specific recommendations for investment advice here, just a discussion of asset classes. But we do generally like non-traded real estate and private equity for sure. Private equity can take on a couple of different forms. There's obviously direct investment opportunities, which are more limited because you have to know about those, but oftentimes it can come as a private equity fund. The non-traded real estate also comes in a fund wrapper where you invest into the fund and you buy at a share price just like you would a mutual fund, but rather than investing in publicly traded companies, you're invested in companies that are not public. They're still private, but the fund, the creator of the fund, oftentimes owns pieces of many of those companies.
Yeah, and that helps diversify within the fund itself. So not all of your eggs are in one basket. It's in real estate. It's kind of if you want to be a landlord and you go out and buy one rent house and you've got that rented out, maybe you've got a good renter, maybe you don't. I mean, some of you have that experience. But if you have a bad renter and they move out and you have to put a lot of money into that one rental property to come back, it's going to take a lot of out of pocket on your side. But when you're able to invest in a company or a group that does this on an ongoing basis, they're not limited to just one property. They've got multiple properties and they are able to manage those. So if they have trouble with one of them, it's similar to owning a mutual fund where you have numerous stocks in that one bad apple that you've invested in within that fund. If it goes south, the rest of the portfolio is going to hold that up and continue to make that move forward. Or that's the goal. And so what we want to be able to do is identify those companies out there that do this on a regular basis and have done it over a long period of time, and give you the best chance to continue to have your assets continue to work for you and increase.
And one other piece to this, too, before we leave your question, Lee, we don't know anything about your net worth or your income, and those matter in entering into alternative investments as well. Sometimes there are some accreditation requirements that you may or may not even be eligible to purchase some of these types of alternative investments. So it is very important not to enter into investing in alternatives without the guidance of a financial advisor. I want to remind you to subscribe to our YouTube channel for exclusive content you can't find anywhere else to help you discover, protect, and share true financial independence. All you have to do is search for GenWealth Financial Advisors on YouTube to do that. Next up, it's Jason from Benton. I'm 57 with about $2.3 million. I know I'm not planning to retire before 65 unless something happens where I have to. Given my current portfolio size, should I start shifting towards more conservative investments, or is there room to remain more aggressive for growth? The answer, Jason, is yes and yes. Now, I know when you have $2.3 million, it's certainly going to move more if you're full on growth, right? If we have that downturn or we have that volatility that we talked about at the top of the show, you're going to feel it more on your account value than if you had $200,000 versus $2.3 million. But that's not really the point here. The point is we need to talk about your retirement timeline, which you've told us already is 65. But we don't know how you're currently positioned either. So when you ask us, is there room to remain more aggressive? We don't know how aggressive you currently are, because aggressive means different things to different people. Are you in individual stocks, or if you're in the 401k, or are you just talking about growth mutual funds? There's a very different level of risk right there. But I think it's important to determine the fact that you are not going to retire before 65. That is an 8-year window, an 8-year timeline before you will, assumingly, begin taking income from your investments. Okay, so we need to begin to think about what needs to change in your investment strategy. And Tim, I'll let you jump in here. With 8 years out to retirement, all growth is probably not where you want to be.
Yeah, it's time when we use our bucketing strategy. We're looking at 5-year periods after you retire. So if you are retiring at 65 and we still have 8 years, our first bucket is normally the first 5 years after retirement. We're not there. And the second bucket is really year 6 to year 10. And so that is where you fall into the end of that bucket. So there's probably some opportunity to bring a little bit more of conservative investments toward your portfolio, but really you've got 10 plus years from the majority of what you're going to want to be able to save and need, and as far as the time frame goes. So equities are going to be something that you're going to want to have, and it's probably diversified between some large growth, mid-sized growth, small caps, things like that. So you still want to have a diversified portfolio of equities. But really, as far as our plan goes and what your plan would look like at that point, we would start to pull a little bit of risk off, but we'd still be fairly growth oriented. And we can kind of go back to that first question that we had. This is also a time to look at some alternative investments for you as well, and look at that non-traded real estate, non-traded private equity type thing to see if we can diversify the portfolio a little bit more.
Yeah, so when you mentioned the bucketing strategy, and Casey, if you could put that back up on the screen for our viewers, the people watching online, why would we do that, right? The reason we do that is we are trying to battle the 3 big risks associated with retirement, okay? For Jason, who is still 8 years out, when you reach age 65, the reason we want to be conservative and have some growth is because, A, we have inflation risk. That's one of the big 3. We know that to be true. Over the last few years, we've experienced high inflation. It's settled down now to 3%, but we need an asset class that is going to, at least historically has, and should continue to outpace inflation. That's why we have the outer end of that bucket in a growth strategy, because if we start off with an income plan for Jason that says he wants $2,000 a month out of his assets, that's going to need to be $3,000 a month in the future, so we have to have more there available. But why conservative on the front end? Well, that is because of sequence risk. Our second risk there is if we are all in growth, as Jason has kind of alluded to, do we want to remain more aggressive for growth? The money that you're going to use in day one of retirement doesn't need to be at risk at all. We need to preserve the principal because we are trying to count on, in the example that I used, being able to send $2,000 a month. And then the final one is longevity risk. That too points towards the growth side and as well the income side, because we need to take a look at your guaranteed income sources. Are you going to be able to outlive your money? Well, if you have a certain level of guaranteed income in place that will always pay the bills, then you're really just using the buckets for discretionary income and then cost of living adjustments along the way in case those bills get higher. So that's the way we would approach changing your investment strategy. It has to start with the plan. And in Jason's case, he doesn't need to really start with bucket 1 yet because he's not drawing income, but we need to take a look at maybe positioning a bucket 2.
Bucket 2. And I think one of the big things, like you mentioned, it goes back to the plan. So really building a plan on what income needs to look like at age 65 and what income sources are you going to have besides these, the 2.3 million and the growth that you can have on that between now and then. Are you planning on starting Social Security? Are you married and have another second Social Security payment? There's a lot of different things that we can factor into our plan, and that will really dictate exactly how much risk we need to pull off the investments based on how much time we do have.
Yeah, and from an income perspective, Jason, you're probably in pretty good shape with a $2.3 million portfolio, especially with the fact that you're 8 years out from beginning to pull from it. It's probably going to be larger. But don't forget about what you might be missing. It's not just about the income, but it's about the gotchas out there, I'd like to call them the elephants in the room that nobody wants to talk about. There's healthcare costs. There's long-term care costs. There's taxes. Work with a financial advisor to work through those two to maximize your retirement income. And if you'd like to walk through the GenWealth Ready to Retire process, if you're like Jason and you're worried about your portfolio as it gets larger in your late 50s and preparing it for retirement, we have an advisor ready to step in and build you a retirement income plan. If you'd like to reach out and get started, that first appointment is free to conduct. All you have to do is send us an email, show@getreadyforthefuture.com. Tell us you're ready to meet with a GenWealth financial advisor, or you can call us toll-free at 866-653-PLAN. That's 866-653-7526. And to begin to tweak that investment strategy, I'd also say to Jason and anybody else who is in that late 50 realm, something you should consider as well, and Tim has already mentioned it on our first question, if you're 59 and a half or when you reach 59 and a half, ask your employer if there is an in-service distribution available. What that basically means is, when you can leave, when you leave your job or when you retire, you have access to your 401k funds. The eligibility is there to roll it over to an IRA. Many employers will allow that to take place while you're still working once you have reached age 59 and a half. And Tim, they know the reason that's in place is that they know most 401ks are built more for accumulation, not distribution.
Yeah, the 15 or 20 investment options you usually have inside your retirement plan are some of the best performing, at least looking back in the rearview mirror of the past, stocks, stock funds, bond funds, things like that. And they are really built for growth. They're not built for protection of the assets necessarily or a distribution of those assets in the next few years. So that's why we really need to make sure that we can get that money over into an IRA and have a lot more options as far as the investments go.
If you listen or watch to the Get Ready for the Future show, very often, we name a question of the week. There it is. It's time for Jason to get a mug, or a tumbler, I should say. Congratulations, Jason. You're our question of the week. We're going to send you a free Get Ready for the Future show tumbler. All you have to do is email us to claim it. Send it to show@getreadyforthefuture.com, and that plugs out there for everybody else listening and watching too. We want your questions. We want you to send in a question, whatever you have on your mind about retirement, Social Security, investing, the economy, anything you want to talk about regarding money or finances. We are here to answer it, and you might be named the question of the week and get a free Get Ready for the Future show tumbler for doing it. Next up, it's Stefan from Little Rock. I'm 45 with about $500,000 in various account types. I make around $200,000 a year. Should I consider Roth IRA conversion in light of potential tax changes and my current tax bracket? Thanks for the question, Stefan. The two most important considerations, we say it on this show all the time, for whether to do a Roth conversion are time and taxes. So what are we talking about? Let's talk about the taxes. So it can be a good time to make a conversion from a taxation standpoint. Making $200,000 a year, You're going to be in a federal tax bracket around the 22, well, assuming that you're married, it's 22%, right? I'm going off the cuff here, Tim.
That's right.
About 22%. So 22% federal tax bracket according to today's tax rates at $200,000 a year. So if you convert, you have some wiggle room at $200,000, again, assuming you're married filing jointly, because I think the next bracket doesn't kick in until over $300,000, somewhere along the way. So you could convert a considerable amount of pre-tax dollars into Roth dollars without jumping into the next tax bracket, and you're going to have to pay 22% on the conversion to do that. If it's all pre-tax, you got to if you convert $100,000 gets added to your income for that tax year. You're paying taxes on it, and then moving forward, the Roth IRA is tax-free. And because you're 45, that brings in the time piece to that. You've got a lot of time potentially before you're actually going to touch that money, potentially 20 years if you retire at age 65. So it might make sense to have that long-term growth on the back end. But the key there is analyzing, first of all, you have to have the money on the sidelines to pay the taxes.
Yeah, you don't want to take a distribution from your retirement account, because that's also, if you're under 59.5, going to hit you with a 10% penalty. So it really wouldn't make any sense to do it at that point. So really, you need to have that money on the sidelines to be able to, in your savings account or in your checking, wherever that happens to be, and manage that conversion, because you can do it. You don't have to do it all at once. You can take this $500,000 and do it in chunks, $20,000, $50,000 a year. And you probably, there's lots of schools of thought out there. I don't know if you really need to convert everything, because in retirement, you are going to have, income taxes that are going to be a part of your overall plan anyway. But having a lot of Roth dollars definitely helps you manage what distributions you can take and manage your taxes actually in retirement. Because if you did have just all pre-tax dollars, which a lot of people do because they've just contributed to their retirement plan for so many years and it's built up to $2, $3, $4 million, you're going to have to take a big chunk out of that, and you're going to be moving yourself into higher income tax brackets as you go. And then if you're unfortunate enough to lose a spouse early in retirement, now you're having to file single with that too. So, there's a good likelihood that your income tax brackets are going, and income tax rates are going to be higher in retirement than they are now, because we're in really a historic low for income tax rates at this point.
That's hard to believe, but it's true.
It's true. It is hard to believe, but being able to go ahead and doing some things now, even in the 22 and 24% tax brackets, to be able to convert some dollars. But again, you need to have those dollars on the sideline to be able to pay those taxes, so that you're able to make that contribution and that conversion over to the Roth, and then let those dollars grow for another 15 or 20 years. And then you're going to have a lot of options in retirement to be able to pull out dollars completely tax-free on the growth and everything that's in that Roth account.
Yeah, and here's the other piece to that, is we just have a few more minutes on the show, but when you think about where he is at $200,000 a year, again, he doesn't tell us if he's married or not, but if he is married, he's still eligible, Tim, to go in the front side of the Roth IRA, right?
That's right.
You could begin to build Roth dollars at 45. If you're not already, he may already be contributing to a Roth IRA, but with two members of the household, you're not ineligible to contribute, and you can actually make contributions for your spouse, even if they don't work, as long as you're filing jointly, right? So under 50, you're getting $7,000 per person. That's $14,000 a year. And once you cross over 50, currently, you get a $1,000 catch-up contribution. That gets you to 8, so it's 16 total. You do that for 20 years. Do the math on that with an assumed rate of return of even 8%. You've got a lot of Roth money. And then the other piece to that is, have you checked out, and anybody else listening who's considering Roth contributions, or Roth conversions, I should say, have you given any thought to going to the Roth 401k? Is that a possibility? Because that has really changed prolifically, Tim, over the last few years since we've been doing this. I think when we first got into the industry almost a decade ago, that there weren't too many 401k plans that offered a Roth 401k. But now more and more are offering it. And if you're trying to build tax-free income in retirement, the Roth 401k gives you a higher contribution limit than the Roth IRA.
Yes, and if you're doing currently maybe 10% pre-tax, you may not want to flip it all just to go straight Roth, because it is going to be a change in your taxes, because obviously you were saving that by doing the pre-tax. Now you're going to have to pay the taxes up front. That's coming out of your check, and you got a smaller take-home check on a regular basis. So you may want to adjust that a little bit, maybe move to a 5% pre-tax, 5% Roth, see what that feels like as far as your monthly budget goes, and keep challenging yourself to put more and more in the Roth, because your limits prior to 50 are 23,500, I believe it is this year, and then 31,000 if someone's over 50. But I think the big thing with the Roth is, again, it's the time. And so having the time available, having the higher contribution limits in the Roth 401k, and if you're getting a match from your employer, which you likely are, that's going to be pre-tax dollars anyway. There's no way around that. You can later convert that if you need to, but you're going to have pre-tax and Roth dollars in your account if you are contributing to the Roth. So being able to get as much money in there as possible, and especially people that are under 50, I believe, the Roth is the way to go, just because, again, going back to the time.
Yeah.
And so I think that's going to be very helpful to build that huge retirement account and have all those options within your retirement years to be able to take that money out completely tax-free.
Yeah, I think the bottom line is work with a financial advisor to build your retirement plan and see if Roth conversions can fit into that equation. But everybody wants a tax-free retirement. I think the deal is, and you see a lot of people advertising that, have a tax-free retirement. We've got the secret to having a tax-free retirement. It's easy to create a tax-free retirement. It's not easy to create it without paying taxes, because you're going to have to pay taxes on something to get to the tax-free retirement.
They're going to get you one way or the other.
Exactly. You heard the bell in the background there. It's time for our final thoughts, Tim.
I guess my final thoughts, we've got a lot of good questions today, and there's so many more out there. You get a lot of different things that you hear around the water cooler, talking to your friends and your coworkers. If you want to be able to come in and just visit with us, and of course Scott said that first meeting is always just free, and sometimes it's just education, and educating is what we like to do. And I encourage you to call and schedule an appointment and get on our calendar. We can sit down, we can go through some things, maybe sort some things out so that maybe a 59.5 rollover distribution, something you hadn't thought of and you're not sure if your company even offers it. You can come in, we can sit down, we can kind of talk through the advantages and disadvantages of that, make that phone call with you, and even determine whether that's a possibility for you. But really being able to get that all squared away is something that we would like to be able to do for you.
Hey, my final thought is, if you're listening or watching and you live in the South Arkansas or North Louisiana area, I want to tell you about an event we've got coming up in El Dorado on Tuesday, March 11th at 6:30 at the El Dorado Conference Center. It's a workshop entitled How to Reduce Taxes in Retirement. We were just talking about that, right? So we're going to talk all about taxes in retirement and preparing a strategy for that. It is free to attend in El Dorado, Tuesday, March 11th, 6:30, El Dorado Conference Center. Visit getreadyforthefuture.com/academy to sign up or check for upcoming events in your area. And that's all the time we have for this week's Get Ready for the Future show. Glad to have you along, the last one of February. We move into March next week, and we hope you'll join us then and get questions into us. It's easy to do. You can call or text to 501-381-5228. We'll see you next time.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.